Everyone, welcome to Jenkins Mac program, Lifelong Learning. This is our July 25th session. This is the last one we're having this summer, so thanks for joining us. If you feel comfortable, please cut your video on so we can see your smiley faces. Love to see everyone today on this beautiful Friday. Hopefully no one's outside. Than that. Hey Aubrey, how you doing?
Good, how are you?
Glad to see you.
You too.
Glad to see faces out there. See, we're going to call you out. We're going to call you guys out. Okay, good. Anyway, I'm going to get started because we know you have a lot of questions today. So if we can go to the next slide, Vanessa. Okay, just to remind everybody, the summit, hopefully you have this down. If you don't have this date yet, please put this on your calendar. You should be getting bombarded by us on social media and other emails with this right now, but the summit is on the 26th. We've got a great looking lineup here. Some new stuff, some revisiting things, and I think you will very much like the day. We're in the same place we were last year, but you can see by the titles there, we got some really good suggestions that were put together by our advisory council on that. Also, the next slide is the MAX celebration. Hopefully you put this on your calendars as well. We had to move it back a week this year just to get a facility, but we're still on a Thursday evening, Thursday the 13th at 6. So please put this. You'll start getting bombarded by us in about a month or so on this date as well. So you can put that on your calendar. That would be good. And finally, just wanted to remind you, this is a CPE session. You can earn CPE from this. We calculate based on your actual attendance, so stay on to the very end to be able to get your CPE. We do track by individual participant in that, and you're required to attend the full time. There's going to be some knowledge checks coming up. Hopefully that doesn't drive anybody crazy, remembering the knowledge checks when you were in the MAC program. But anyway, we will move on with knowledge checks just to make sure we know you're there. And so with that, I'm just going to move on to our speaker today. When we put this together, knowing what was going on in Washington, we said, let's just put a tax topic in there. Not much going on. Probably people won't have many questions about this tax topic. And then we thought about, well, who would be the person that we could get? And immediately to the top of the list came Dr. Nathan Goldman. Okay, Dr. G, as everybody knows you. And so we got Nathan on today, and he is going to tell you everything you need to know about taxes with all the things that are out there. I will say that he is open to questions today, but he's going to quickly say, I don't know the answer to that question yet. So after your questions, we may need to get back in touch with you. So with that, Nathan, I'll turn the time over to you.
Awesome. Thank you so much, Scott, for that wonderful introduction. Before I begin, I did want to welcome everybody back to Nelson Hall. As you can see, I'm in my office here. If you look really closely outside the window, you can see Hillsborough Street with lots of cars going by. It's a hot summer day, but we're really looking forward to the start of the semester coming up and a new class of MAC students to be joining us. On that note, too, it's so great to see so many former MAC students in the audience. I think I saw a student from my very first year here as a faculty, Leslie. I think I saw you on there. I see a student from my most recent year on here, Aubrey. So it's great to see y'all and welcome back. And thanks so much for being part of this for everybody here. As Scott mentioned, the title of this presentation is What's Next for U.S. Income Taxes. We came up with this title in April. So it really was like oh, hey, what's going to be coming up? Little did we know that on July 4th, like 2.5 months after that, we had this massive change to our U.S. tax code. So I'm going to do my best, just kind of talk about what's going on, where we were, where we're at now, what we can look forward to in the future. But just a brief summary of what's happening with U.S. taxes right now. I think I could summarize it first with, confused look. Okay, what's going on? I'm not totally sure. New information is coming out every day. Some people are looking at all this with a little bit of a face of disbelief, a little Steve Harvey, not really sure what just happened there. But I think a lot of people, especially us accountants and CPAs in this room, are probably sitting here with a nice bucket of popcorn saying, oh, this is great. This is exciting. So with that, I almost have this like new title of what just happened with U.S. income taxes. And hopefully we'll be able to talk just a little bit more about what exactly is going on. So just a brief introduction. I've had some of y'all as students, but my name's Nathan Goldman. I'm a professor of accounting here at NC State University. I've been teaching the accounting 530 class, taking over for Ernest starting in the fall of 2019. So that's the advanced income tax class. I have my PhD from the University of Arizona, and I am a CPA in the state of North Carolina. So I actually used to work at Deloitte in Charlotte. I got my CPA license here before moving away, and then coming back to North Carolina here to be on the faculty at NC State. In terms of some of the other things I do on campus, I'm a Park faculty scholar for the class of 2027. So they are the current juniors right now. That means I'm one of the faculty advisors for this amazing group of students that come in here with a full ride via the Park Foundation. And they, in addition to having a full ride, they also get 2 faculty that are their like mentors the whole way through. And I'm one of those 2. So it's been a real pleasure to be part of the Park group. I'm also a university faculty scholar, which is just a designation that you get for excelling in areas like teaching and research and service. So that's something that I've been very proud to have earned here at NC State. One thing that I earned or that I started doing 4 months ago tomorrow, actually, is that I'm an academic contributor to Forbes. So what this means is I write articles about what's going on in the tax world. I'm actually going to be referencing some of those articles throughout this presentation. But it's something that, they pretty much ask that I write, at least 2 articles a month, but I can go up to 10 per month that I write about what's going on. So of course, in the month of July, I maxed out at 10 like 4 days ago, just because of everything that's been going on. So it's something that I do as part of my service and extension for the university. But it's also something that I hope you guys get some value out of, because I'm going to cite some of my articles as we go through this presentation. And lastly, on the kind of the academic research side, I do publish a lot of papers, and one of the titles that I currently have is I'm an editor for European Accounting Review, which is Europe's premier accounting academic journal, and I mostly do handle tax papers there. Okay, so this presentation, what we're mostly going to be focusing on is the past, present, and future of U.S. taxation. Oh, with that, I think we do have our first knowledge check question from Vanessa. So as I'm kind of going through the just what we're going to go over, go ahead and fill this out. But I'm going to start off first by just saying what were things like before 2017? I think 2017 was just a pivotal year in how we are taxing here in the United States. I'll talk about the Tax Cuts and Jobs Act of 2017, which, even though it's like, okay, yeah, that was old news, it's still very pivotal to what happened this year. Then we'll dip into the One Big Beautiful Bill Act, talking about individuals, businesses, and just other miscellaneous topics in there. And lastly, I'm going to end with just a few items of like, what else should we be thinking about as we move forward? Okay, so life before 2017. So the year is 2017. What happened that year? Well, we started off early in the year with a miraculous Super Bowl comeback. I don't know if anyone remembers, the Falcons were up 20-3, and then Tom Brady led his incredible comeback. All right, so if you're a sports fan, you're already getting the mindset. That was a little bit of time ago. If you're not a sports fan, maybe you remember Emma Stone and Ryan Gosling dancing onto the big screen and into our hearts as well with their hit film La La Land, which almost won Best Picture until PwC messed up the tabulation for that. And we had Brexit. We had Great Britain and the United Kingdom breaking away from Europe and being part of their own kind of economic structure there, breaking away from the European Union. But probably most pressing for the tax purposes that we're talking about is we had Donald Trump be inaugurated as the 45th president of the United States. And the reason why that was very important is because he is what led to, at least his platform is what led to the Tax Cuts and Jobs Act of 2017. So let's first talk about what things were like on that day when he was being inaugurated. The US, relative to all the other OECD countries in the world, had the highest corporate tax rate at 35%. It also had very high individual tax rates, which I'll show here in a minute. But you can see the discrepancy between the US and some of the very comparable big trading partners, allies that we have in the world. We had the highest corporate tax rate of anybody. In addition, we had one of the few countries that was taxing on a worldwide tax system. Now, you might be looking at this and seeing US is in blue. A lot of other countries are in blue, but if you look at the other countries in blue, it tends to be either the BRICS or just some of the less developed countries. So the more developed countries, the ones that are OECD countries, are mostly in green. They are territorial tax system countries. So our system was a bit out of sync. We had very high corporate tax rates. We also had a worldwide tax system. And problem with the worldwide tax system, and for anyone that was in my class, you probably even might remember this slide, but there's really three key issues with it. The first, it discourages companies from repatriating foreign profits. So if you think back, all that money that Apple had invested overseas, they just kept it parked there. Some of it was just straight cash that they had because it was too expensive to bring back overseas. We also had companies that were inverting outside the US. So one of the most classic examples of that was Burger King. They merged with Tim Hortons, and the surviving entity ended up being a Canadian company, Tim Hortons, even though Burger King was way bigger than Tim Hortons. So we had companies that were doing these inversions to artificially locate themselves outside the United States. And what this ultimately led us to have is a very competitive disadvantage for our companies. So corporate taxation was just kind of out of flux in the United States, and we knew some sort of reform needed to happen. But also, if you look at the individual tax rates during that time, now you might be thinking, okay, the top rate is 39.6. I think a lot of us know it's down to 37% after the TCJA, but look at where it was picking up. Look at where we were picking up our top tax bracket: 415,000 for single, 466,000 for married joint filers. These tax rates were hitting individual taxpayers at much lower levels than what we're seeing now. So the Congress decided that maybe it'd be a good idea to give some relief across the board via these tax rates. Okay, so now looking at what was the TCJA, it's kind of the opposite of what I just said. We had a huge drop in our corporate tax rate. We switched to this quasi-territorial tax system. So the tax code still says we're a worldwide tax system. But if you meet certain qualifications, if your subsidiaries meet certain qualifications, you could treat those subsidiaries as territorial in the way that the other countries treat them as. So it kind of creates this quasi-territorial tax system. And there were a lot more changes that happened here. So again, the lower corporate individual income tax rates, huge benefit. But when you lowered those corporate tax rates, you also need to lower the rates that other businesses are going to have to face. And that's what introduced the QBI deduction, which is that 20% tax deduction for these flow-through businesses that they have. So the non-corporate entities. But it wasn't all good. We had a lot of limitations that were imposed. Probably most notably was the limit to SALT deductions, which we'll talk about here coming up. We also, for businesses, we have less advantageous NOL carry back and carry forward provisions. We have lower interest expense deductions. And we have this expiring R&D expense, which we'll talk about here as part of the One Big Beautiful Bill Act. We did allow bonus depreciation temporarily. And we had limitation to executive compensation and much, much, much more. So to say that I could summarize it all in one slide is probably just a disservice to everything. But I think looking at, we could say, okay, the TCJA did change a lot. Thankfully, now we have several years of data since then, and a lot of academic studies have picked this up and said, okay, what actually changed with the TCJA? We have a paper by Bullock, Gartner, and Vernon. And this is one of their figures here on the left, and they show just how the distribution of effective tax rates changed from before the TCJA to after the TCJA. As we could have expected, there is this leftward push. There's this push that is lowering the effective tax rates. Before the TCJA, on average, companies had this like cash ETR of 25%. Now we're looking at 22% for this on average cash effective tax rate. It did change incentives across the states too. So in Kumar 2024, we could see that the decline in taxes that are being paid went across the board, across all the states. But we look really closely, the ones that are in red are those states that don't levy a state income tax. So what this is saying to us is that, yeah, we had this decline in tax liabilities, but because of that SALT deduction limitation, the decline was mostly felt by those states that weren't necessarily levying taxes on their individual taxpayers. We saw a shift in multinational taxation. So the study by Garcia Bernardo, Jansky, and Zuckman, published in 2023, shows that there was this huge decline in profits booked by U.S. corporations in these overseas tax havens. So the ones that we usually expect: Netherlands, Luxembourg, Singapore, Switzerland, Ireland, we see this drop off in the profits that companies are booking in overseas jurisdictions. One of the reasons for that is we had GILTI and BEAT that were installed. These are kind of these tax penalties for companies that are artificially locating income outside the US, not to mention specifically tax havens. So we're seeing companies shifting away from tax havens as part of their operations. And we could see that M&A was severely obstructed. So the number of acquired targets has gone down according to Amber and Robinson, and you can see that sharp cutoff after 2018. Now, was the TCJA effective? That's probably the question we want to know as we're looking ahead to something like the One Big Beautiful Bill Act. Is this something that was effective? Is this something that we could have been, that we should be looking to make changes based on? Now, there's two different perspectives. So one side, they're pretty clearly saying, no, this wasn't an effective use of funds. And that comes from data in particular from the Center for American Progress. What they show in their studies that pretty much the benefits of the TCJA went to the highest earners, the wealthiest taxpayers. They also show that the benefits to the cut in the corporate rate weren't necessarily borne by these low paid workers, which is what kind of they were hoping for. Only a very small percent was allocated low paid workers. Instead, it went to higher paid workers, executives, or even just the people that own the company. And lastly, there was this promise from the TCJA that we would see some sort of increase in investment. So as we lowered the tax rate from 35% to 21%, that 14% savings, that 40% savings in what they would otherwise pay in their taxes should have eventually resulted in companies spending more money and investing it. And we didn't necessarily see that happen there. All right. And then kind of on the flip side, and once I'm done with this, we'll do a couple knowledge check questions. People were wondering, okay, did the Tax Cuts and Jobs Act pay for itself? So yeah, that's great if we can somehow get some benefit out of it, but if it at least paid for itself, then maybe the benefits that we saw were okay. And what we see is that based on the CBO projection, we see that the actual collections increased beyond that, what they were expecting. And in fact, based on this Cato Institute study, there's evidence that says that the TCJA did actually pay for itself. That did lead to these increased tax collections by way of dispersing more funds throughout the economy. So even though there is like conflicting feelings on whether the TCJA was a great thing that we should have done, or even a good thing that we should have done, it does seem like it's at least paying for itself and it didn't necessarily set us back more than what they were expecting. So with that, I will flip over to Vanessa for a couple knowledge check questions. To question number 3. While you're answering that, I'm going to go ahead and start talking a little bit about the One Big Beautiful Bill Act, because that's where we're at today. So in January of this year, we had another inauguration photo. I don't think anyone can forget Melania's hat. And also Elon Musk just hanging out in the background there, as he seems to be doing a lot of lately. But we had this One Big Beautiful Bill Act that was brought forward with the platform of Trump's his main platform is he's running for president this year or last year. And not too long after he took office, Congress began working on this, not just a tax reform. This is really just a reform of everything, his entire domestic agenda, which was the House Reconciliation Bill number 1. Just as you can see here, the One Beautiful Bill Act, it is actually big. And it is actually the name of it. You can see the words right there on page 2. Back maybe says the One Big Beautiful Bill Act. I believe the acronym people are saying is UBA or OBA. BBB, I've heard as well. So I think we're among the things we're still trying to figure out is what actually to call it, just as we had the TCJA before. And sure enough, throughout the first 6 months of him in office, it resulted in this being signed into law on July 4th of this year. And for the most part, the provisions are effective for this year. I know what you're thinking. Look at that really big, gigantic smile this guy has in the background. He's got the whitest teeth that I think I've seen in a long time. Look at that. But really, his giant signature Trump has down there below as well. So this was this was signed into law again on July 4th. Now, a few things to keep in mind and kind of a few caveats of this. This was only signed into law 4 weeks ago. Literally, we're still in the same month that this was signed into law. Treasury and IRS are pouring through this thing. I feel like I see updates at least every other day, if not on a daily basis, that say, here's something we need to be considering. This is something that was clarified. I think we're going to be seeing these updates and these clarifications all throughout the year. I do not have all the answers. I like to think that I've stayed on top of this. I like to think that I've kept in touch with what's going on and what's in this bill, but I don't have all the answers. So please bear with me. If there's something that you've seen here, or if you have questions about it, I'm happy to answer questions or discuss anything. I don't necessarily have all the answers right now. I'm going to discuss some key items from this, both on the individual side as well as on the business side. Now, I think these are going to be the items that are most interest to the group as a whole, but even more so, they're most interest to me. So these are the ones that I've decided to talk about in detail. And lastly, I'm not going to discuss anything besides the tax law changes of the One Big Beautiful Bill Act. Again, this was the entire domestic agenda. There's a lot of things that change that have nothing to do with tax. I'm happy to have conversations about that outside of this, but this is a tax CP, so we're going to talk about the tax items. All right, so let's look a little bit at the individuals. And here's the 7 key items I'm going to talk about. Let's just jump into it. So the first, I put in parentheses or brackets there, no changes to ordinary income tax rates and standard deductions. So we could see here in 2016, this is the 2016 tax brackets that we had here on the left, side by side with what we have now in 2025. And we might be thinking, okay, the top tax bracket went from 39.6% to 37%. Not a huge change. And if we didn't have this One Big Beautiful Bill Act, we would have gone back to the 2016 tax brackets, or at least something that's inflation adjusted for that. But I want you to take a close look at someone that makes $300,000. So if you make $300,000, your marginal tax bracket in 2016 was 33%. In 2025, it's 24%. So it's important to not just look at what the top tax bracket is, but also what are the people in the middle going to be dealing with?
Hey, Nathan, can you pause for a second? Your audio went out.
Oh. All right, I'm back.
Okay.
Scott just came in too. Okay, can everyone hear me now? Okay, perfect. So we see the tax brackets did change quite a bit during this time, but also importantly, the standard deductions changed. So 2016, we had fairly low standard deductions. We had married, filing jointly at 12,600, single 6,300. So going into the TCJA, these effectively doubled, and they've been going up every year as indexed for inflation. So in 2025, we had, at least what we were projected, we were supposed to have 15,000 for single, 30,000 for married, filing jointly. I was actually really excited. I think my students were going to be really excited because I make them remember this information. And for the first time in a while, we had these really round numbers to use. But then under the One Big Beautiful Bill Act, they decided to give taxpayers a little bit more money. So now my students are going to have to memorize these 15,750 and 31,500 instead. Either way, the One Big Beautiful Bill Act did increase the standard deductions a little bit for taxpayers. Okay, so we're changing the tax rates, or at least kind of keeping them steady, increasing the standard deductions a little bit. Let's switch over to the itemized deductions. This is probably in my opinion, the biggest change that's going to be affecting a lot of taxpayers here, and that's the SALT deduction. So under the TCJA, we decided to take the SALT deduction, which is your state and local income taxes paid. And instead of having to be unlimited, we decided it was going to be capped at $10,000. Meanwhile, we also took the standard deduction and made it small and made it really big. So the result was most taxpayers just ended up starting to take the standard deduction. They weren't able to find $30,000 of itemized deductions when they could only use $10,000 for SALT. Well, now we are raising that number to $40,000. So it's a fourfold increase. And it's really going to benefit a lot of people that live in these high tax rate state jurisdictions. So if you think of places like New York and California, they pay a lot of taxes, but they also have a lot of property taxes because their houses are expensive, things like that. They just pay a lot of income and property and state taxes all together. So now they can take a SALT deduction of $40,000. Now, it's important to point out this is for just 4 years. And this $40,000 adjusts for inflation every year. So it's going to go up a little bit every year. And the last year will be 2029. After that, Congress will have to revisit this. Now, this is something I talked about in a Forbes article, and I'm including some of these QR codes throughout. So if you're interested in learning more about this is a QR code related to the study that I wrote, or related to an article I wrote for Forbes that just talks about what the actual benefits are. But what I talk about in this article a bit is that because it starts phasing out $500,000, you could actually do the math and see that it'll be fully phased out by $600,000. So the goal isn't to give these incredibly ultra wealthy, high income individuals these bigger SALT deductions. It's intended to really go towards that either middle class or upper middle class or lower upper class, however you want to designate it, to really ensure that they can get tax benefits and be able to maximize what they're getting from the state and local taxes that they're paying. And lastly, one thing that's important with this is that if you make more than $600,000, so if you're fully phased out of this $40,000, you still get the $10,000 deduction. You don't get less than $10,000, but if you make too much, then you're going to be capped off at the $10,000. So we had benefits for our homeowners or people that are earning money especially in these high tax jurisdictions. But what about the people that may not own homes? What about the people that might be the service workers? And I think we could all remember a key talking point during the election last year was this idea of no tax on tips. It was at a rally in Nevada that Trump rolled out this idea of no tax on tips. Again, Nevada is a jurisdiction that has a lot of people that earn money based on tips, these service workers. And it really caught fire. In fact, it got to the point that his opponent, Vice President Harris, also adopted it, saying, yeah, you're right, no tax on tips. So it seemed like this was going to be something part of the legislation. But it wasn't exactly what we thought it was going to be. So again, this goes from 2025 to 2028. So it is a limited time. So it's not no tax on tips forever. It's a limited time that they're offering this. I do expect it, like a lot of things, to be, reenacted over time because it is a good idea. But it also came with a lot of catches. So first, you must work in a qualified occupation. I think when me and Dr. Llewellyn were writing an article about this, we talked about like, hey, what's to stop some sort of executive to say, oh yeah, that $10 million in stock compensation, that was just a tip. It wasn't my income. It was just a tip. So you can't just be like an executive working for a firm. You have to be some sort of service worker. There's a whole list of qualified occupations that hasn't been released yet, but we get the idea. It's going to be people working in restaurants, hairstylists, people working casinos, things like that. But what was probably the biggest limitation of this is a $25,000 deduction for tip income is what's there. So even if you are someone that's working in this industry and you make $100,000 on tips, only the first $25,000 is going to be eligible for this deduction for tip income. So it's kind of no tax on tips. There's no tax on some of your tips. And lastly, you can't earn too much. Now, the vast majority of service workers make it less than $150,000, so it's not necessarily a limit there. But if you are a service employee that makes tons of money, more than $150,000, you do start to get this phased out. But it wasn't just no tax on tips. There's other things that were kind of geared more towards this class of taxpayers, because not all taxpayers get paid on tips. There are some that get paid hourly, but they have to work a lot of overtime. So again, we have this no tax on overtime. That was $12,500 maximum deduction. So not necessarily no tax on overtime, but no tax on some of your overtime. And again, that's AGI limited. And then also related to this class of taxpayers, we have a car loan interest deductibility, where you can actually deduct the interest that you pay on your car loans up to $10,000. And the reason why I say it's geared towards this class of taxpayers is because it does have a $100,000 modified AGI limit where it begins phasing out. So these are kind of these deductions that were geared towards taxpayers that are generally earning less than $150,000. Those that work for tips, those that work in service fields that get paid overtime, or even those that are trying to buy cars. But what about the kids? We have some stuff in there for kids as well. We have child tax credits and Trump accounts. So what exactly is a Trump account? This was another thing I wrote about in Forbes. It's a $1,000 Trump savings account for all children born between 2025 and 2028. They get a $1,000 tax deferred IRA. So for those of y'all out there that are thinking about having kids, make sure family plan, have them before 2028. You get a free $1,000 that gets put into this account. And what it is, it just sits in this account and it grows tax deferred. And once the child turns 18, if they take out the money and use it for education, if they use it to buy a house, which I know it's not much to buy a house, but if they use it to buy a house, if they use it to do start up a small business, then the amount that it grew by can be taxed at the capital rate. If they just take it out and spend it on whatever they feel like spending it on, that's not one of those qualified areas, then the money that accrued gets taxed at the ordinary rate. And if you're thinking about like an 18-year-old, they are not traditionally high income individuals. So if they take it out and use it for college, that money that accrued, they could potentially be applying it towards college and paying taxes at whatever their capital gains rate would have been, which for a lot of them would be 0 for that rate. So it actually is a great deal for these children. Once they turn 18, they can take the money out. But it's more than just this free $1,000. So families can actually contribute to this $5,000 annually. And also the family's employers can do a one-time $2,500 contribution for the child. So there's a lot of money that can be put into this. There is some concerns that this is going to be geared more towards the upper class taxpayers because they can contribute $5,000 annually and they tend to have the resources to be able to do it. It's kind of like a 529 plan in that way, but it could be used for that first time home purchase. So it's a little bit more dynamic. And we also have the child tax credit that got renewed. So y'all might recall before the TCJA was $1,000. After the TCJA was $2,000. Now it's $2,500 per child with the $400,000 phase out. So people that have children that are particularly those that make under $400,000 a year get this nice enhanced child tax credit every year. We have some benefits for seniors. So it's an additional $6,000 standard deduction if you're over 65. And that's only temporary. So 2025 through 2028. This was actually part of that no tax on tips, no tax on overtime. Trump campaigned on lower taxes for seniors or no tax on Social Security. If you really think about it, the $6,000 additional standard reduction will actually take care of a lot of the taxes for most seniors that are receiving Social Security. So it takes care of that for some, but not all seniors, because after all, there's a lot of seniors that make a lot of money. So it is something that that he was able to at least gear towards a specific subset of that group. And we have much larger estate and gift taxes. Now, one thing that was kind of interesting that came out of this was the charitable contribution deduction changes. I actually wasn't even aware of this until it finally got passed by the Senate. But it's this really neat change. I think a lot of people were thinking like, oh yeah, charitable contributions are great, but I don't itemize my taxes. So what's the point? Is this something I need to do? Well, one, a lot more people are going to be itemizing their taxes now that we have these new SALT deductions. But also the Congress shifted some of the charitable contributions from being below the line as an itemized deduction to being above the line. So now any taxpayer or single taxpayer can take a $1,000 deduction to qualified charitable organizations, or if they're married, can do a $2,000 deduction. So you don't even need to be itemizing to be able to get this deduction. Now, if you're sitting here thinking like, oh man, that sounds great. Who can I possibly send some money to? My favorite charitable contribution is to NC State. Go back. All right. That's a little side note. But if y'all are thinking like, okay, maybe this is an opportunity to finally be able to make charitable contributions, this is a great opportunity because it goes ahead and allows you to take this deduction above the line instead of below the line, only if you itemize. But what they did do for the itemized deduction is they made the itemized deductions a little bit more limited. So there's a 0.5% floor for itemized deductions, meaning that if you make $1 million a year, your floor is $5,000. So you get to take the first $2,000 above the line. That's a deduction everyone now needs to take. but then you would need to be donating at least $7,001. So you need to get past that $5,000 floor to be able to start taking itemized deductions for your charitable contributions. So I think the net effect of this is a lot more people are going to be providing these charitable contributions because you get the tax benefits, whereas only some people got the tax benefits before. But we're going to see that floor start to create a little bit of a wedge in terms of when people are actually going to be donating beyond that $2,000. Lastly, this is something that has been in the forefront of my mind. Me and Dr. Llewellyn wrote a few articles back when North Carolina legalized sports gambling. This is something I wrote about in Forbes as part of the tax impact on the gambling industry, but Congress did something that was really interesting. So before this year, and really goes into effect in 2026. So we could just say in 2025, when you gamble on sports, you're actually, anytime you win a bet, you're increasing your gross income and you're also increasing your itemized deductions. Because that's the only way that you could deduct the losses against your wins. And you can never deduct more losses than your wins. There's all those rules around that. But what happened this year, and it goes into effect starting in 2026, is that your loss deductions are only limited to 90%. So if you're a taxpayer and you win $10,000 in Vegas and you lose $10,000 in Vegas before or this year and earlier, you actually just kind of net those two together and you don't pay any taxes, right? You bet money, you won, you lost, you broke even, you don't pay any taxes on it. Well, what happens now is that you can only deduct 90% of your sports gambling losses. So if you're that taxpayer and you win $10,000 and lose $10,000, you broke even. But according to the One Big Beautiful Act now, you will have $1,000 of taxable income. Now, if you're thinking, how would they ever know all those things? It's a very messy system. It's going to be difficult to uphold. But that is still going to be $1,000 of taxable income that you're going to be liable for. If audited, you could be facing some penalties if you don't report it. Okay, so let's look a little bit at businesses now. So those were kind of some of the key individual positions. Let's look a little bit at businesses. And just to jump into it, the first thing is that there's no changes to the corporate income tax. And actually, Vanessa, do we have a knowledge check here? I think she's going to be posting a knowledge check here.
Sorry, yeah, I can go ahead and do it now.
Perfect. So there's no changes to the corporate income tax rates. And I think y'all are saying, well, why would there be changes? The change in 2017 was permanent to go from 35 to 21%. But I think what was key is what all the discussions that were happening, not only when Trump was on the campaign trail, but also subsequently thereafter. There's a lot of discussions about, well, maybe should we be having a different tax rate? He floated around 15% for companies that are operating more domestically or manufacturing domestically. I think if Trump didn't win, there was talks about raising the 21% rate back up to a higher level. So the change was made permanent in 2017, and there were no changes this year. So the lack of a change is kind of a big innovation that we had from the One Big Beautiful Bill Act. Something that's very pressing to the folks here in the Research Triangle was this R&E expenditures. So, and I remember talking to one of my former students, Chrissy Norris. She was working for BDO at the time. Now she works for TJT. And I was talking to her and she said that like all throughout 2022, everyone was sitting around waiting for Congress to come in and say, okay, you could go back to expensing your R&E expenditures. You could go back and to expensing what you're spending on research and development. Because starting in 2022, you had to capitalize and amortize as domestic research and experimentation over 5 years, and foreign is 15 years. So there was these huge steep penalties that were enacted for engaging in research and experimentation because you couldn't just take that immediate expense like you used to. But what happens now is the One Big Beautiful Bill Act is permanently allowing the deduction of domestic research and experimentation expenditures. Now, businesses can still elect to spread it out over 5 years if they want, but why would you not want the free money right away or the deductions right away? What's interesting is the foreign research and experimentation tax credit or expenses that can be deducted are still going to be amortized over 15 years. So we've created this really big wedge, this really big incentive for companies to be locating their R&E here in the United States as opposed to overseas, because they do get these intense tax benefits. They get to expense it right away. Not only are you accelerating the deduction, but the time value money benefits are huge. But a question arose, and this was something I was very interested in once they finally passed, is what happens to all the money that was amortized starting in 2022 onwards until now. Well, what Congress decided is that if you're a small company, $31 million of gross receipts or less, you could take that expense immediately. So right away, companies were starting July 4th, they were just hitting the expense for all this R&E that they had amortized away. But if you're a bigger company, over $31 million of gross receipts, then you expense this over 2025 and 2026. So you spread it out evenly throughout the next 2 years. So these companies, especially those that are like the biotechs, the pharmaceuticals, a lot of companies that are headquartered here in the Research Triangle are going to be seeing a lot of this expensing come to fruition over the time here. We also have bonus depreciation come back. So bonus depreciation is now 100%. It was 100% with the TCJA. It was phasing out. It was supposed to be 40% this year. It was going to go down to 0% in 2027. But now we have 100% bonus depreciation for pretty much anything that has a cost recovery period of 20 years or less, and it is permanent. So makers, I think, still exist. I think we're still going to be teaching that. I think we're still going to be learning all about it. Because again, at the state, not all states recognize bonus depreciation. So companies still need to be keeping track of what exactly their makers depreciation is. But we do have now 100% bonus depreciation until someone changes it otherwise, which I totally expect will happen when we have a regime change. And we have Section 179 immediate expensing thresholds also increased because, again, why do we need 179 if we have 100% bonus depreciation? Well, some states just don't allow bonus depreciation. We had the 163J, the business interest expense limitations, did kind of revert back to what the deduction was in 2017. So throughout the TCJA post period, they kind of went to a different formula based off of EBIT. Now they're back at EBITDA. All you need to know is now they're a lot more beneficial for companies, just like they were in 2017. And we had some big changes to multinational provisions. So y'all have probably heard these acronyms. We have GILTI, we have FDII and BEAT. So GILTI and BEAT are kind of these sticks that the government's using to encourage companies to operate more in the United States and not have this artificially located income outside the United States. And then FDII is this carrot that we give to companies, this beneficial tax rate that allows companies to pay lower taxes on their income from exporting goods overseas. Now, these incentives or these sticks were going to get more severe if we didn't do anything this year. So the GILTI rate, which was currently 10.5%, was going to go up to 13.125%. FDII, the beneficial tax rate, was going to increase, and the BEAT penalty was going to increase. So all these things were going to get a lot worse for companies if we didn't do anything after this year. And what we did is we kind of been in the middle with the One Big Beautiful Bill Act. So instead of the GILTI rate being 13.125%, now it's going to be 12.6%. FDII is going to be 14%. BEAT's going to be 10.5%. And I can already sense my students this year like rolling their eyes at trying to remember these numbers, because these are not fun numbers to remember, but they are going to be things that you'll have available to yourself as you're going through this. And we have the CFC look-through rule was permanently enacted. This actually came back. This was something that was passed in 2006. It allows companies to move cash freely overseas without having to pay repatriation taxes on that cash or on that property that's moved overseas. It's a really beneficial act for helping stimulate our global economy and provide incentives for companies that are headquartered in the United States. This is something that was permanently enacted. It came from something that was from 2006, so it probably isn't on most people's radar, but it was being reenacted, repassed every like 3 or 4 years since 2006. So now this is a permanent thing. Okay, I covered a lot of provisions there. One thing I did do for Forbes when this was on July 3rd that I published these. You can see the published date at July 3rd, 2025, 2:27 p.m., 2:25 p.m. I had these things ready to go the moment that the House passed it and it was heading to Trump's desk. In fact, the one on the left, it was trending on Forbes for over 24 hours. I think I had 35,000 hits in the first 24 hours or something like that. They were fun articles to write. Feel free to scan these to pull them up if you're interested in learning more about what I wrote there about these, about the One Big Beautiful Bill Act, whether it's affecting individuals or corporate tax. Now, you might be thinking, okay, I discussed about 10 or 12 things there. There was so much more, even just related to taxes. Probably the two things on here I'd even want to point out is that the QBI deduction is now permanent, and we have these opportunity zones that kind of came back into the fold. So we had these opportunity zones that were passed as part of the TCJA. Now those are really out there. I could have probably spent the entire presentation just talking about opportunity zones, but I just wanted to point those two out as other provisions that were not discussed. Okay, so what else should we be thinking about? So that was a lot of One Big Beautiful Bill Act stuff, and there's a lot going on there. Well, what else should we be thinking about that's unrelated to the One Big Beautiful Bill Act as we look forward to the second half of 2025? I'm going to break this down into three key topics. The first, we have a new IRS commissioner. Second, we have a lot of concerns about what I'm going to call capital flight. It's not an airline, it's something else that we're going to talk about. And lastly, we're going to talk about ASU 2023-09. So I think some of y'all that are working in corporate accounting or corporate taxation are familiar with what exactly this is, and we'll talk about it here coming up. So first things first, we have a new IRS commissioner. His name is Billy Long. Now, Billy Long is a auctioneer. That's what he is best known for in the state of Missouri. He was a professional auctioneer, very well regarded in that field. He ran for Congress and was elected as a congressman in Missouri. He then ran for Senate and lost. And he's, I don't want to use the word unemployed, but he's been doing other things since his failed bid to become a senator, including he got this certification, the Certified Tax and Business Advisor. Now, you might be thinking like, oh, what's that? Well, it's something that's offered by a company called Excel Empire. So it's not offered by like a state credentialed organization like the North Carolina Association of CPAs or AICPA or anything like that. So by a company called Excel Empire, and they specialize in helping taxpayers lower their tax liabilities as much as possible. Notice how I'm not saying like legally lower their tax liabilities as much as possible. And if you look at some of the things that they advertise, they talk about how, you know, oh, if you own your own business and you build a swimming pool at your house, well, that's a employee fitness facility. I think most of us would say, hey, that's kind of sketchy. So anyway, that's something that he's been very actively involved in, and that's his most credible accounting related, tax related credential that he has. So he's not exactly like a career CPA or a career financier like we've seen a lot of times with people that are leading the IRS. He does have a promise for more efficient tax audits, but I think a lot of his promises are along the lines of making the IRS smaller, making the IRS more focused on just going after the people that they believe are being tax cheats. And I think there's a lot of concern just because he is someone that was explicitly selected by Trump, that as we're seeing with other departments that are kind of being shrunken down, that this is a way to sort of help circumvent the system. It's something that I'm definitely keeping an eye on because I think this is going to set the tone for what we're looking at as we move forward in the United States and how we're doing our tax enforcement. The budgets are going down. I was talking with Kathy Krozik earlier today, and she was talking about one of the proposals called for a 20% reduction in IRS budget. Another one is calling for a 23% reduction in IRS budget. So we're seeing the IRS budgets go down, but we're seeing people make lots of money. And are they paying their fair share? When someone like Billy Long is in office, I think there are some questions that are coming up, given that he's been promoting a lot of these kind of questionable tax positions and trying to get away with things like that. So it's something I'm a little bit curious about as we move forward. And it even goes as far to say, look at what Trump did just at the end of May with Todd and Julie Chrisley. Does everyone know who Todd and Julie Chrisley are? They are kind of a socialite family. They were on a TV show called Chrisley Knows Best, and they went to jail for tax evasion. Very famously, they effectively got rich off of forming their own mini Ponzi scheme for just borrowing money and not paying it back and using that money to borrow more money and onwards to project this high society lifestyle that they had. Well, at the end of May, they were pardoned by President Trump, saying that, okay, well, yes, you are still tax cheats, but you don't have to spend your time in jail. And I think that's kind of the tone that we're getting out of that, along with this new IRS commissioner who seems to be much more focused on taking the most possible deductions out there, whether or not they're legitimate or not. Okay, the other thing that I mentioned was capital flight. So what I meant by capital flight was this idea that capital seems to be shifting around this country in an unusual way. We saw this back in February where we had Kentucky, right? KFC, Kentucky Fried Chicken, which is now going to be headquartered in Plano, Texas, right by Leslie Cunane, I believe, right? You're in Dallas, right? Perfect, yeah. So it's going to be moving its headquarters to Texas. Now, KFC is part of the Yum Brand Corporation, so it's not just KFC, it's Taco Bell and Pizza Hut as well. but they're moving to Texas. So we see companies that are saying, hey, and we saw this right with Tesla and SpaceX, all these companies leaving California to go to Texas as well. But we're seeing it not just companies, but also individuals. We saw Jeff Bezos relocated to Florida. Why? Because in Washington, these high net worth individuals have to pay capital gains tax when they, in the state of Washington, when they sell their shares. Well, what's great about Florida? You don't have capital gains tax. So Jeff Bezos moved to Florida and he saved about $1 billion in all of his time that he was selling all these shares in his company in Amazon to help support his lifestyle. We actually also saw this. This was an article I wrote literally just this past week, published on July 21st, about In-N-Out CEO. So In-N-Out, the famous California burger chain, their CEO decided that she was going to relocate to Franklin, Tennessee, and live there. Now, she didn't say anything about the word taxes in this, but did say that Tennessee is a more business-friendly state. Tennessee also happens to have no individual income tax and no tax on dividends, no tax on capital gains. So this was an article I wrote just highlighting about how there's this capital flight issue that's happening as we see people that are relocating to these other jurisdictions. Now, the reason why this is a little bit pressing is because we actually have two situations that are arising in the US that I think could potentially be leading to additional capital flight. And it's these two very young, energetic politicians that are running in cities. So we have Zohran Mamdani, who won the Democratic nomination for the New York City mayor. And he is proposing, along with Omar Fateh, who won the Democratic nomination in Minneapolis, they're both proposing these local tax hikes on local taxes that individuals are going to have to pay. But what's interesting about it is it's not just that they're saying, okay, we need to have a city tax in New York City. We need to have a city tax in Minneapolis. But they're saying they want it to be progressive, meaning that they're aiming for the lowest earning income individuals to pay almost nothing in taxes and the highest earning individuals to pay the majority of these taxes. So what's the problem with that? Well, cities are small. It's easy to move outside the city. So someone that's living in New York City can just as easily locate to their house in the Hamptons or somewhere in New Jersey or Connecticut or somewhere else and just say this is their tax residence and they work most of the time there and avoid this tax. Or probably more pressing is that they could just leave New York State or Minnesota altogether. So it'll be interesting to see how some of these proposed tax hikes are going to have the same effect that we're seeing with the corporations in relocating capital. And the last item that I'm looking forward to is ASU 2023-09. So this is probably the biggest change in accounting for income taxes that we had since the FIN 48 took effect in 2007. So it's been 14 years. I was talking with one of the FASB board members, Christine Bazin, about this quite a bit when it was in the works. Her and I had that discussion in 2017, and it had been in the works for several years, even at that point. So this is a long time coming. And even as it says right here, improvements to income tax disclosure. So we're going to actually be having way more income tax information disclosed in the financial statements. We're going to get a lot more country by country reporting. We're going to get a lot more information about the tax uncertainty. So those UTB footnotes are going to be significantly enhanced, or so we think. Because what came out, and this is literally off the press from July 21st from a Bloomberg article, is that currently the GOP is threatening the FASB funding over these tax disclosure rules. Now, I did my Google search on this. I tried to see what actually was happening. It was from a colleague that I had at the University of Wisconsin that put this on my radar. And I couldn't find anything on it. It wasn't until I really dug deep that I saw multiple articles on this. So it's not something that's really circulating around quite as much as some of these other big tax items. But it is something that if you're working in corporate accounting right now, you might be thinking like, or if you're working in on the tax side, you might be thinking like, okay, our clients are getting ready. My company's getting ready for ASU 2023-09. But is it? And it'll be interesting to see if this actually ends up happening, if they end up going through with this, because I know a lot of companies are already preparing for this, but it seems like there's a lot of pressure from the legislative branch on the FASB to try to at least alter these disclosure rules or maybe postpone them for a little bit. All right, I think we have one more knowledge check, Vanessa. We have one more knowledge check that we're going to go through. But one thing I just wanted to highlight, as I mentioned, I don't have all the answers for all these things. I think these are, and obviously there's even more important tax topics that are out there right now beyond just capital flight, a new IRS commissioner, the changes in the FASB, and what we have coming up with ASC 740. I don't have all the answers. These are just some of the things I just wanted to talk about here. But most importantly, we just have a fun, dynamic tax world right now. I hope this information was helpful as y'all were kind of getting yourselves ready, getting back in the tax mindset, whether you're working in tax or corporate accounting or audit. I think all this is very helpful and relevant for us. Please feel free to follow me on Forbes. I love sharing my articles, and just hope to be keeping this much in touch with the tax world as we move forward. So with that, I want to thank you all so much for your time, and go Pack.